Hello, good evening. Bloke here, and this is going to be on the Silver Producers ETF, which is SILG, and it's also known by a few other things. Sorry, there we go. Monitor's in the way. Yeah, so I'm the Oak Bloke, and this is my Substack. Uh, None of what you're going to hear today is advice. You make your own investment decisions. But um, yesterday I released the update. So this is just a bit of fun, really. But looking at my ideas for 2025, which came in at a 18.6% year-to-date return. One of my readers did better than me, 28.6, including dividends. So well done to him. Very good performance. But you can see there's a few famous. Famous being a relative term, I'm sure, but some well-known celebrity uh, uh, people who gave their 2025 ideas. So those were in the public domain. So they ended up on this fun run. So we can just see what's working, what's not working, and so on. Anyway, that's by the by. But yeah, my Substack is theoakbloke.substack.com. So that's just who I am. So going to talk about silver. Now this is the Silver Institute, and you can see here the deficit, the market balance. It's pretty much been in deficit since 2019. So deficit, 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 deficit. Uh, Slightly lower deficit, but still a deficit. So, and you can sort of see here the growing demand. So since 2019, about 15% growth in demand. And here we can see growth in supply. Well, 1%, 1.5%. I mean, it says there year on year 2%, but 1015 to 1030, that's 16 in 16 million ounces, 16 mozes in 6 years. So the point with silver, and this presentation on SILG will be an example of this, is that it's not the case that you find and have a silver miner. You have somebody that is a poly miner or polymetal miner. In other words, poly is many, that they don't just mine silver. They just don't. It is virtually unheard of that you will invest into just a silver miner. It'll be silver and gold, silver and copper, or silver and zinc and lead. And that's just the nature of how these deposits get laid, the types of rocks and the geophysics behind it all. I'm not a geologist, so I'm sort of just sort of describing just the commercial reality more than anything else. But yeah, as we can see, whilst photography, so what, 34 back in 2016, so in 10 years has dropped 34 to 24, but then we've got some areas of growth. So industrial 491 to 677. So you can sort of see, there's sort of areas of growth, areas of contraction, photography being but this photography area has been a contraction for so long now that, well, I mean, keep going and there'll just be no photographs printed out, full stop. I think you still are going to have a base level of demand for photography, because at the end of the day, people still do get pictures converted into physical photographs. Not so much, but you go in people's houses and they've got stuff on their walls, and it's not going to go to zero. So this deduction here, and what you'll notice, I mean, what's interesting is the just the this reduction here of physical investment. So you can sort of see it was sort of running at 280, 330, and it dropped down to 190. So there was a big drop in just investment into gold. In other words, silver. Did I say gold? I meant silver. Sorry. But yeah, basically the investment flows are kind of what's kept this market balance from being a problem. But you can see here 190 to 204, yeah. So that sort of basically people sort of selling off their silver in order to keep the market, well, not in order to keep the market in balance, but basically the interest in silver dwindled until last year, but has picked back up again this year, not by very much. I mean, you consider 204, and this physical investment is probably the most mobile. And what I mean by that is you're not going to kind of fundamentally influence the number of photographs that get taken around the world. You just ain't. The jewelry. I mean, that's again, it's pretty much, you know, some people like silver jewelry, some people are allergic to some, to yellow or whatever. There is just, these are sort of more fixed, is perhaps what I'm trying to say. This one, physical investment, is not. If there's people recording, like Oak Blokes recording videos about silver shares or silver, uh, newspapers and just different people talking about silver, then people will invest into it. And equally when there's negative articles, oh, like so and so's lost all his money on silver, then people obviously run for the hills. And that's kind of what's caused this reduction, and that's a sharp reduction. I mean, you look at that's 150 million ounces less silver. So anyway, that's kind of the background to this. And um, what you'll see as well is there's also recycling. So to some extent, there are people that will recover silver. And that can be as simple as like old jewelry becomes new jewelry, that kind of thing. But also recycling in the sense of like solar panels contain silver, various electronics contain silver. So sometimes it is practical to recycle or to recover the silver, and other times it's not. I do remember somebody telling me that it was quite expensive to recycle silver, that was a problem, but clearly not that much of a problem because it accounts for 20% of the entire supply of silver. You can see here has done for numerous years. So yeah, I think whoever was telling me that about silver didn't know what they were talking about, because clearly here there's plenty of recycling of silver. Anyway, that's the background. So just close that down. So there's a background of the shortage that has been sort of masked or hidden, has now been unmasked, I guess you could say. And if we went and looked at the price of silver you can see here, it's up 21%, which is not even as much as gold. Now, silver is normally what do they call it? The hyperactive cousin of gold. Gold will go up 10%, silver will go by 20. Sorry, let me just move that so you can see it. I appreciate my pictures in the bottom right corner. But yeah, if we go back in time, let's just sort of think about. Don't think Trade and Economics allows you to go 25. Look, they say, oh, you subscribe. So 10 years. I mean, obviously here with 35, that's a record over 10 years, and we can see we had a bit of a jump here. But back here we had $50. So in recent times, if we can say like 16 years ago, something like that, it was recent, maybe 15 years. But yeah, there was a spike of price back here. Okay, so look, that's the background. So one of my readers said, "Oh, I have chosen to invest in SILG. Now it's called SILG in London. If you're a non-UK person watching this video, fear not, because there is a GY SI. Well, yeah, you can see it for yourself there. I won't read all of these out, but there's an Italian, German, Swiss version of this ETF as well, and it obviously trades in different currency. This one actually is interesting because obviously the holdings themselves are pretty much all USD, so you can sort of hedge or not hedge accordingly with GBP or with USD. And as you can see here, I mean, it's obviously over 1 year, it's done well, up 45%. I mean, that's obviously that's a good, great performance. Who wouldn't want a return of 45%? I mean, if I've closed my article now, but obviously, if I just said buy SILV a year ago, I would have been the winner of my little fun run competition, and that would have been the end of it. Um, Hindsight's a wonderful thing. But yeah, look, it's obviously gone up a lot. So obviously the question then is, well, can it go up more? And of course the answer is potentially yes. Let's have a sort of little look at what's inside. So what you'll see, I mean, a couple of things to say. Ongoing charges 0.65. I mean, it's I mean it's not cheap, it's not horrific, 0.65, but it is I mean it is a little bit on the slightly painful side. And obviously because this is physical full replication, then they are buying and selling shares, so there'll be trading costs. Well, question is, does that include the trading costs? See, that's management fees, other expenses, transaction, total costs. No, that does include. Yeah. So okay. Well, look, that's a bit better, to be fair. Okay, so anyway, I always I'm always of the mind that if something is the right thing to do from the fundamentals, then if you're paying a fee, that's that's what you do. If you can make 45% on something, if you're paying out 0.65, who cares? Sorry, I think that's just my opinion, but it's not worth worrying about. You would be cutting off your nose to spite your face. So yeah, as you can see, it sort of trades over a few different places. It's obviously because it's an ETF, it's I suppose efficient inverted commas. There's not really an investment trust that directly covers silver that would be an alternative to an ETF. So it kind of is what it is. I mean, there are a couple of articles, Silver Explained, Silver Could Shine, nothing really, that you're going to sort of learn. Well, maybe I'm cynical, but I don't think there's an awful lot that you'll learn from those. Down here now, you'll see this price earnings 45, price earnings in the current year, or this will be forecast price earnings. So yeah, that's kind of forward looking is 22.95, which obviously is very reasonable. Yeah, if it turns out to be that. Price to book 2.5, 2.3. Again, I mean that's obviously it's not cheap, but these are good assets. So again, it's not entirely unreasonable. Return on equity 10.5. Again, not amazing, but and obviously the average size of what you're buying here is an 11 billion market cap company. These are not tiddlers, these are not juniors, and you'll see vast majority are Canadian or Canadian listed at least. Another 15, so 3/4 North America. This one is pretty much Fresnillo and Hock, which are Mexico and Peru. So obviously this is just country breakdown based upon where they're listed. This one was a bit of an oddity. We'll come on to that, but we'll talk about South Korea in a minute. And obviously Peru, Mexico appear with a tiny little bit of Australia. I mean, you'd imagine there would have been much more in Australia, but there isn't for silver, surprisingly, I thought. But anyway, that's that. Excuse me. These are the top 10. So, well, we'll get into the article. I think we've pretty much exhausted what we wanted what I wanted to show you here. So, if we get into the article, these are the top 10. Wheaton being the top, Pan America, where you can read them for yourself here. And you can see, there's, what's it, 14, 13, 7.8, 7. So kind of big weighting towards Wheaton and towards Pan American. So, okay, let's kind of look at these a little bit. So, a couple of things I'd say. Number one, Wheaton, very well-known company. I mean, I'd be surprised if you'd never heard. Well, maybe you haven't heard of it, but it is one of those sort of um, names that's pretty synonymous with gold and silver. What these guys do is royalties. Essentially, and you can see here, there's vast majority of their royalties are in low cost producers. They've got an average mine life of 27 years. There's 4 new ones coming on stream. They've got 900. I mean, this is like a 910 contractual order book. The point with royalties, I mean, the attraction of royalties is that if the miner that's mining the gold or the silver goes bust, well, whoever buys that mine, whoever buys them out of bankruptcy or whatever happens to that mine, basically the person that inherits the mine or buys the mine, buys it out of administration, then still owes the money because the royalty is over the asset or over the ground, not over the company. So that's something that's worth, that essentially theoretically, you don't get bad debt ever, because if the one guy goes bust, then the next guy comes along and he's got to take on the debt if he wants to buy the asset. That's part of buying the asset. So there can be attractions to royalty companies. The slight disadvantage, a couple of disadvantages, and I've only sort of realized or learned these things. I think realized more than learned, because I don't think anyone has taught this. But the problem with a royalty is that well, I mean, royalties can be different, but typically it's a percentage of revenue. So if you're making $1 billion revenue, let's say, and you've got a 2% royalty, well, you owe somebody 20 million quid a year. Yeah, that's how it works, is that it'll be a percentage of your sales, essentially. The problem with that approach is that when the price of silver goes up, let's say silver goes up 10%, so now I'm making 1.1 billion instead of 1 billion. Basically, my royalty's gone up by 2 million. My royalty is linear, okay? Whereas, let's say my profit margin's 10%. Let's say it's cost me 0.9 billion to produce a billion of. If the price goes up 10%, my profit's doubled, yeah? But the royalty company's profit's not doubled. It's gone up by 10%. So obviously not all royalties are structured that way as a percentage of revenue, but pretty much most of them are. So if you are buying a royalty company sort of going goody goody, the price of silver is going to go up, well, you're not really going to make much of an upside. I mean, you'd be better off buying a silver miner and enjoying the doubling of profit. Okay. The other thing to say about royalty companies is they're normally terribly expensive, and that's the case here. I mean, yes, they've got wonderful, 400, 390,000 ounces of gold, 20 million ounces of silver. So really, really great results. That you see it here. There's, 80 cents per share for 1 quarter, so that's $3.20. In the space of a year, it's up 64%. I mean, it all looks marvelous, really does. I mean, it is very impressive. And you can see here, the forward picture is that this is going to grow from about, well, you saw it 590, 590 up to, well, you make your guesstimate there, about 9 something, 950, let's say. Well, growth to 870, it says there, look, or 950. from 2030. So more and more and more are coming online. Because again, like this is the other thing about royalty companies, right? You don't pay to build the mine. The person that you've lent the money to pays to build the mine, yeah. But when they start producing, you get your 2%, you get your cut, you get your royalty. So you don't pay costs. And if I don't know, the mine floods, there's terrible rain, the mine floods, the cost of production triples and you make a terrible, or the miner makes a terrible loss. The royalty company doesn't care. All they care about is, well, how many ounces did you produce? Think of Tony Beats in Gold Rush, if you watch that program. Like he'll kind of say, "Oh, how are you getting on?" What he's asking is, "How many ounces have you produced?" Because he gets a royalty on those ounces. So he what he wants to hear from you is how many ounces you're producing. Because the more ounces you produce, the more he gets his cut. He gets his royalty. So uh, excuse me. Anyway, that's. So there are some positives to it. Moving on to Pan American again, are some positives. They've just bought Mag Silver. They've divested a few different other holdings as well. So they are going, let's call it more silver-like. Okay, more silver-like. They've spent $500 million on buying Mag Silver, so that's obviously not a small purchase. And then this is what they've purchased: Juanicipio, which is in Mexico, which is down here. Look, so of all the mines in the world, cost curve basis, it's sort of one of the lowest, so therefore one of the most profitable. You can see it up here as well. That in fact, let's zoom in so you can see that bit better. There we go. So Juanicipio, huge numbers of reserves, and the co-product all-in sustaining cost. So all looks good. All looks good. Very modern, state of the art. Blah 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 blah. They've also got mines throughout North and South America. So you can see here they've got stuff in Chile, Brazil, all over. Very large reserves. I mean, look at those reserves. 468 million ounces. I mean, that's just vast. If you can picture what 468 million ounces of silver looks like, well, and 6.7 million ounces of gold. I mean, these are reserves, so they haven't dug them up; they're in the ground somewhere. But that's a lot of reserves. I mean, yeah, you'd address a few silver market shortages with those reserves, shall we say, if you can get them out of the ground. And they've got a 30-year history as well. So again, very solid. Kerr Mining, Canadian, so it's obviously Quebec with a name like that. So they again, they're sort of all heading in the right direction. Bit to margin growing, and obviously this, free cash flow growing. This is partly down to higher prices of silver, but also down to growth in production. We then come to the fourth largest. Now this is kind of where I went, really? So, I mean, these are the sort of historic for the last 4 years. This is the silver portion here. So you can see, this is a zinc producer that makes a bit of silver. So it's a bit of a weird one, I feel, for it to be the fourth largest holding. It's not really a silver miner at all. It just has a bit of left, like a little byproduct of silver. 19 million ounces. I mean, it's not a small amount. 19 million ounces is a decent size, but this is predominantly zinc and lead with a little bit of silver. So not much to get excited about that. Second one is another royalty company. So again, it's just think about that from the point of view of if silver goes up. Again, they sort of boast low-cost mines, same sort of thing, and you'll probably spot some names in there that you recognise. For me, CAML is a holding. Taseko I've looked at in the past. Eldorado is one of the Golden Prospect holdings. Caliber is as well. G mining is as well. So yeah, lots and lots of really, you could see lots in Canada. Well, really a lot in Canada, with a few, Kazakhstan and few in Mali or West Africa somewhere there, few in Australia. So again, you can sort of see here they've got sort of net smelter royalty. And I forget these acronyms. I did know them. GRR is gross revenue something. Um, so yeah, there's a few different agreements, and you can sort of see some of them are 1%, 2%, 3%, with the various different counterparties. So again, positive number of ounces production, or volume. Cash flow per share has grown a lot. So in 10 years it's tripled. NAV per share has doubled. So again, positive. Um, I haven't covered every one of these 10, but Heckler number nine largest. I call this one out because of its so this is its grade, very high grade. I liked Heckler actually, high grade, with a very, very low AISC, all-in sustaining cost. So there's Pan American that we saw earlier, there's Core that we saw earlier. So you can sort of see the silver grade, boof, boof, compared to the silver grade of Heckler, completely superior. Now, you might look at those and go, well, hang on a minute, you just showed me these really positive slides about these other ones. Well, yes, because they are also producing other things. So the top 10 come to like 70% of the NAV. I mean, this is perhaps where I start to go a little bit negative on this. Now, first thing to say is that whilst this is called silver producers, it's not actually majority silver producing. It's 41% silver. And all I'm doing here, by the way, is not sort of even considering the copper, zinc, blah, 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 blah. All I'm doing is I'm saying, here's the ratio of gold and silver. Okay. So it's actually lower than 41. It's just trying to work through the it's easier to just sort of take silver and gold and say, well, the taking a 93-to-1 ratio, so 93 ounces of silver equals 1 ounce of gold, which is today's market prices. It kind of comes out where it's actually majority gold. It's 2/3, well, not quite, but near, 60% gold, 40% silver, yet it's called the silver miners or silver producers ETF. So I think you've really got to think about that one and bear that in mind. I'm not saying that makes it a non-starter, but you are buying something that says it's something on the tin, but inside it's kind of flavored with silver rather than it being silver, pure and unadulterated. So yeah, you're not getting as much silver exposure as you might imagine, because obviously if your thesis for buying this or to invest into this is you say, oh well, silver's going to go up to $50 or might go to $100 or whatever your thesis might be, higher than today presumably. If it does go higher, well, you're going to see 40% of the benefit of that. And what you're actually sort of also having to worry about, or maybe not worry is not the right word, but what you've got to consider is, well, what's gold going to do? Because if gold, I mean, I'm not saying it will, but I mean, theoretically, there's 7 times more silver being produced than there is gold. So the abundance of silver is only 7 times larger than gold. So for silver to be priced 93 times less than gold, perhaps gold's too expensive, or perhaps silver's too cheap, or perhaps it's both. Now, I'm not saying gold's going to go down, because the difference is that central banks don't buy silver, they do buy gold. Okay. And central banks are buying a lot of gold, and there's very, very few. Again, if you looked at the investment flows of ETFs, up until last year, there was very, very low levels of interest with gold, particularly with all that's been going on with crypto and all of that nonsense. I think people have just forgotten gold, apart from a few diehards, a few gold bugs that cling on remembering the heydays of 2010 and 2021 when gold went up in price. It went down to kind of well below its cost of production. I mean, it was to the point where, if you were invested in something like this, I mean, I haven't gone back and looked at what what price it was, but silver was very, very low in price as well. I mean, it's obviously made a big comeback. Um, so yeah, look, I mean, that's what you've got to that's the first thing to bear in mind. The royalty companies, the linear upside, I think, is another thing to bear in mind. Also, to just think about the costs of production. I mean, what I've done is I've just taken the last numbers, so per ounce AISC, silver price, and to come up with some rough profit estimates. Now, these are going to be sort of based on the last accounts. I haven't tried to do any forward forecasting of what the profits would look like. So, what this chart I'm about to show you will show you is I'm sort of basing it on today's um, based upon a sort of $32 price, a $37 price, and a $50 price. That yeah, you'd sort of see what if any upside there would be. And I'm also going to show you something where I'm saying, well, if we then consider the price earnings, so VSPE, that that what that was also going to sort of give you is an indication of which one is the cheapest relative to how much it's going to cost you to buy. So in other words, to buy the earnings, what price are you paying? So let's go and look at that chart. So there's the top 10. That's where they're based. That's their share price as of Friday. This is how many shares are held by SILG, and that's the value of the holding. So you can sort of see that's where they're getting the NAV figures from. So in each one of these, I've done a calculation of silver versus gold. So apart from Korea Zinc actually did say, zinc and lead are 53%, so also 54%. So these are 46. So I've done 31 and 15, but every other one, basically it's sort of proportions of adding up to 100%. So there might be other metals, and I've just not bothered on the basis that hopefully they're not materially important. What I've also put in is, again, taking probably the quarterly result, so the 1Q25 result, quadrupled it. So, first quarter times 4 is 21.5 million ounces. I've done the same on gold with kilo ounces. Okay. I've then done that divided by 93 to get that. So that plus that is that. Okay. So all of those, essentially you're getting that many gold equivalent kilo ounces. I've also looked for any news flow of increased production. Again, it was, I mean, obviously with the royalty companies, of course, they're going to be increasing because that's the nature of those sorts of industries. But yeah, that wasn't sort of immediately apparent growth in apart from this one, which was again the royalties. So it was just the two royalty companies that disclosed growth. With the AISC, obviously with the royalty companies, well, that wouldn't be a sensible number, so there is no. And with the zinc, again, there was no AISC because they're making zinc, and the silver's just like a byproduct. Yeah, so there's no sort of calculation there. But for all of the others, I mean, it ranges from $13 per ounce of this is AISC of silver, by the way, between 13 and 22. So obviously this one, the Decla mining is the most attractive, and then the Fresnillo came out actually with the highest cost. So the and then price earnings, again, I'm taking the latest numbers, so you can see everything is very expensive. So on average, the price earnings across the top 10 are 67. Now you saw on that page from Global X that the price earnings is lower. I don't know how they're basing that number or where they're getting that from, but let's say that's true. Fair enough. But my calculation of these top 10 at least, obviously I haven't gone into stuff below, but this is 70% of the NAV and it comes to 67, which I thought very expensive. So what I've done here is I've said, well, based upon that level of production, okay, so this is all just on silver, not considering the gold, not interested in the gold because this is about silver. What would be the revenue? And then, obviously the AISC based upon that production level gives us an AISC total. So what we see is as silver goes up in price, if silver goes up in price, so this is sort of silver from a year ago, let's say, okay, so it was $32. Today it's 37. So you can sort of see, compared to a year ago, Wheaton is now making, just over 100 million more based upon there being higher silver prices. Yeah. Okay. So I'm sort of taking sort of estimates of each of these, but then I'm also extrapolating. Well, what if silver goes to $50 an ounce? What will that mean? What will that mean? So anyway, where I get to is that, and this upside here is based upon, well, okay, if I'm selling 1 billion of silver, okay, and it's costing me 390, so I'm making 610. Compare that to, I think it was this number here, 640 minus the 390 would be 250. So I'm making 244% more than I did before with $50 silver. So in other words, whilst these are kind of similar numbers, this one, because it's got the lower AISC, there's less leverage. And if you think about that for a minute, if you've got a higher cost price, an increase in revenue will have a disproportionate effect on the amount of profit you make. So, going back to my example, if I'm only making 1% profit and my revenue goes up 10%, well, my profit increases 11-fold. If you're making 10% profit and revenue goes up 10%, you've doubled your profit. You're the lower cost guy, I'm the higher cost guy, but my profit's gone up far more than yours because my profit was lower to start with. Yeah. So 195% is actually the worst one. 280 Fresnillo is the best one because of its higher AISC. And I sort of sat there, thought about it. I was like, oh, actually, yeah, that's oh, sorry, let me move move the article so you can see the 280. Sorry, it's blocked. Anyway, what I then did was I said, well, let's take the price earnings and say, well, this upside relative to the price earnings, and this isn't sort of a massively scientific way of looking at it, but what it exposes is that, well, on that basis, compared to what you're paying per, for each dollar of profit, let's say, and this 243% increase in profit, well, this one and this one, so Pan American and Industrias Penoles, are the best options. These ones that are not applicable, it's just you can't calculate it because of it being a royalty or not easily calculate it. So yeah, anyway, that was that was sort of what I got. And this one, by the way, was making a loss incredibly, First Majestic, which is why there's a zero there and not applicable there, was that there wasn't any earnings to price. So anyway, that was that one. Anyway, that's yeah. So to conclude, I mean, the thing that just kind of makes it difficult for me is this price earnings of 66. I just think that's very, very expensive. I mean, yes, if silver went to 50, yes, of course you'd make some money because of course it would go up. It definitely would go up. But I guess I just started to think about, well, what would I do in this scenario? Like what other options would also be appropriate? Well, I guess Oh, and yeah, I mean, these are sort of just some of the different top tens. They're all very impressive companies. I'm not saying they're not. They're all sort of making Heckler particularly actually the one with the low cost all-in sustaining cost. Making some, but you can sort of see here, it's 44% silver, 33% gold, and then lead and zinc, and so again, you're only going to get sort of 44% of an upside of an increase of silver prices. Just something to bear in mind, and you can sort of see there, strong margins, strong cash flow. So all looking good. Yeah, investing into the mines and so on. Um, so yeah, I wrote this article some time ago, yeah, back in March, and I was sort of pondering about which, yeah, like what would I do in this scenario if I wanted to invest in silver production, which of course, very sensible thing to be thinking about. Um, Golden Prospect crossed my mind, but it's just not got enough silver in there for it to be classed as a silver. It's predominantly gold, 90% gold. So yeah, it would be a bit silly for me to say, oh yes, well, why don't you consider that? But this does have a surprising amount of silver. So I covered it in this article certifiable, which is this one here. Would you be certifiable? And it's got three projects. It's got the Don Nicholas, the DNM, as its acronym is. This has actually got, you see, the AG is the silver. So this has got 6.6 million ounces. Now, obviously, compared to the many millions of ounces that we saw in all of those large producers, 6.6 million ounces isn't necessarily that much, but you've got to remember that the market cap on this is completely different. Its market cap is, where has it gone? Market cap is 54 million pounds, I'd like to say. So it's a lot cheaper. Yeah, sorry, 57 million market cap is there. So yes, you've got this, and this is a producing mine, by the way. So this isn't just an explorer. This is a producer. To be fair, the producing it's been producing has not been terribly profitable thus far. They've been rectifying that. They've got uh, improvements. Some of that is to do with going underground, and some of that is to do with the leaching that they're going to change, and that's changing in Q3, so it's imminent. If you look at the last accounts, I mean, just kind of walk through these very quickly. So the period end March 2025, you can see that obviously they are increasing their revenue, which to be fair is mainly down to the fact gold's gone up in gold and silver have gone up in price. Production costs pretty much identical, so that's a price increase rather than a volume increase. The depreciation's gone up by quite a bit, and I suspect that that is a permanent state of affairs. So you can see that currently there's a 2.2. Now this is based upon 2,500 an ounce. In other words, not a terribly high per ounce amount. That there's more upside on the price to come in future periods. What we see is that there's a one-off cost here of 3.3, which is a remeasurement of the the mine. MDN is the name of the mine. The Mina Nicholas, it's acronym. Yeah, this stream obligation is kind of like a royalty, ironically. So yeah, once you factor that, which is an extraordinary cost. I mean, yes, they lost money, but basically it was because of that. And then obviously you've got a few other things going on as well, but what they've been doing is they've sold off a number of non-core assets. They've also got their increase in production. So June Q2 might be a little bit, certainly better than these results, but possibly Q2 won't be quite there. But Q3 onwards, I would say there's a good chance that we'll see a good improvement. Certainly the management report that they foresee that they're going to be strongly cash generative. And actually, the other thing to say is that they are cash generative. You can see there the adjusted EBITDA was actually 4.8. So obviously in there you've got this remeasurement of the royalty obligation. You've got FX and the translation. You've got depreciation, 4.5. So there's a lot of things that are sort of non-cash that are sort of driving the numbers. So if we went and looked at the cash flow, which is here, yes, you can sort of see the operational cash flow 5.5 million, or net cash flow 7.4 million. So there's a good amount of cash being generated out of this, out of Cerrado. So anyway, back to this. Why do I think Cerrado? So so we are going to see an improvement there. They're sort of getting towards nameplate capacity on Las Calandrias heap leach, and then there's the initial underground mining second half of the year. So that management say will generate significant cash flow, support various projects that are underway. Cash on the balance sheet through those disposals will enable CERT to maintain capital growth and develop the underground. Also to produce the optimized feasibility study at Lagoa Salgada. So 6.6 million ounces in Argentina at the Don Nicolas, but then we look at Lagoa Salgada. So they've got another 9.8 million ounces there. Now, this it's interesting because the pre-feasibility study is based on $22 an ounce of silver. Obviously, with today's prices, it's very, very different. The net present value of the project of Lagoa Salgada, and they only own 80% of this, not the whole thing. MAFL, which I've covered in other videos, own 15, and then the Portuguese government own 5, as it stands. Anyway, this is the what the feasibility study. These were the prices of the feasibility study. So zinc $1.20, lead $1, copper $3.50, gold 1700, silver 22, and then tin 12,000 a ton. So and then they had some long-term consensus estimates of what the prices would be. So you can sort of see, they said long-term the price of gold will be a bit higher, silver will be a bit higher. But look, these are today's prices. So zinc is pretty much spot on. Lead is probably not far off. But look, copper massively up compared to the estimates. Gold is gold's double. Silver's massively up, and tin is up. So there's quite a lot of difference, 98%, 64%, and so on. This is the number of kilotons, or in the case of gold, kilo ounces. It'd be nice if you had kilotons of gold. That wouldn't be 190. That would be 190,000 there. So anyway, this is the upside. So a 20 million upside, just because prices are different. But the other thing that's happening is the optimized feasibility study is very likely going to up these numbers, that they are doing further research, further studies to prove out the resource. It's very likely that this is not just 9.8 million ounces, okay, that it's going to be higher for silver. Anyway, it's got some great economics. I mean, even at these rubbishy prices of $22, etc., it's a 39% internal rate of return, and Yeah, so uh, cash generative. I mean, profit, EBITDA profits of 76 million at these prices. In other words, if we say, well, the like that's this. Well, I've said 75, but this one says 76. But yeah, really at today's prices, the EBITDA profits would actually be more like 100 million a year. So then, if you sort of say, well, you've still got your interest costs, you've got your tax. You know, really you're looking at the very, very, very least. And sorry, this is not even considering Lagoa Salgada. This is just considering Don Nicholas. That by the end of 2025, I reckon this could be at something like 15 million net profit run rate. If that's the case, that's kind of roughly 11 million pounds, which on a 57 million market cap is about, well, I think I said 10 million pounds. 10 million pounds would be 5.7, and that's zero value assigned to Lagoa Salgada or Mont Sorcier. Now, Mont Sorcier, as you can see there, EBITDA profits would be that, and it's basically premium iron ore. So it's 67% iron ore, I think it might be. So it's that's an early stage project, but let's just sort of consider that at zero for now. Um, but the point is that compared to those 10 that I looked at, 12 times less expensive. Um, and so I struggle to pay 12 times more. I mean, the thing you've got to weigh up and judge is, well, obviously it's not going to stay at 66 times. That if profits increase, if production increases, if silver prices increase, obviously back in first quarter of the year, silver prices weren't what they are today. I mean, if that 25 times, or sorry, was it 22.9 times on the Global X website is accurate, then obviously that's very, very encouraging. But yeah, I think in my case, having looked at the numbers, it feels to me like you'd be buying assets very, very expensively. I mean, the other way of looking at this, if you sort of said, well, no, I don't want to go with a small nano cap like Cerrado, completely understand. It's you make your own investment decisions. But the other way of looking at this would be to sort of maybe mull over whether, what you should actually do is take this information. I mean, if your objective is to go for as much silver as you can get, well, this one, number 9, the I think is it Decla? These guys here, I think is sorry, let's just grab Heckler. Sorry, I called them Decla maybe, but yeah, Heckler, largest silver producer in the US and Canada. Obviously, then you've got jurisdiction safety as well, because obviously a few years ago, Hochschild got into all sorts of nonsense when they're when protesters closed their mine, and there's it's not Mexico, Peru can be a bit tempestuous. So like that would be a big plus for me, is the fact that it is physically in North America. 57% silver exposure, that's a big plus. The AISC of $13 per ounce of silver, big plus. Obviously 16 million ounces a year of silver and some gold. I mean, buying it at 51 times earnings, yeah, that's kind of a little bit less attractive, should we say. The upside here, obviously it wasn't the top one at all, but relative to its buy price. But I think there's a lot of reasons why Heckler could be a good one, and obviously just because this came out and this one came out, Coeur and Industrias Penol. Now the only problem with this one is that it's listed in Mexico, so that would probably be a bit funky to get, but obviously Coeur is US listed, Heckler is US listed, so that most people's sort of stockbroker will allow you to trade an American share, and you may or may not want. You may say, oh, that sounds a bit complicated, but that like that's the other way of looking at this, is to say, well, just pick the best one out of SILG if you um, if you want to pursue and you want it to be a big company, and I suppose the fallback here is to say, well, okay, like you don't want to faff around with them buying American companies, or and obviously you can just buy the ETF and see how that goes. But the other way of looking at this is obviously Fresnillo is UK listed, so if you're UK, they are 46% silver, so they're not the best, but they're not the worst. They're valued at an eye-watering 93 times, but I would be sort of thinking about, well, what does the forward um, price earnings look like? Maybe it's not so bad. Obviously, the AISC is another concern, but again, I would be looking at that to say, well, is it going to stay at that, or were there some one-off factors? Possibly, I don't know. Yeah, and that's probably about as much as I can say on this idea. So that's this article will be released in the next day or so. I guess, yeah, I think to conclude, my my thinking was that just be aware of the fact that this isn't as silvery as you might think it was from its name, and it is quite expensive. So just weigh up your options and make your own investment decision. But hopefully, I've given you some ideas around why you should or shouldn't, and also whether something either within SILG might be better, or something else entirely. I mean, there are other options out there. I did cover, just I didn't intend to kind of really cover this, but I did cover this one the other day. I did think this would be a little bit of a nice silver, and it does have this wonderful nugget of, was it 140 kilograms, I think it was. So that's a nugget that would kill you good and proper if it fell on your head. But the problem I had with this one was that they reckon they've got 4 million ounces of silver. Well, you've just seen, I mean, like Cerrado's got more than that, and it's producing. These guys are not producing, and well, 4 million ounces of silver is not that great. And they've done an agreement where 70% of it is now owned by another company, West Coast Silver. Um, if they get to a point where West Coast Silver are going to mine it, sorry, they're going to take it through to a mining decision at a free carry for Alien. But the problem then is, well, how will Alien pay the 30% to develop the mine? And the fallback position then is, well, you can get, instead of paying 30%, you can move your 30% ownership and give your 30% up. In exchange for 2% net smelter royalty. But when I looked at the numbers, I was like, well, that's only worth it's only worth, I can't remember. Yeah, it's only worth 2.1 million pounds. I mean, the Alien shares 9 million. I was just like, well, how's that gonna like like I struggled to kind of even get back to the price of the share price, in other words, from what they had. But I might be wrong in the sense that they are prospecting. Whilst they sort of declare that they've got 4 million ounces, there might be more in the ground. There probably is, potentially is. The only problem is that it costs more and more and more money to go and explore the ground. And at what point do West Coast say, do you know what? Let's go with the 4 million ounces. Where's your 30% Alien? Oh, we haven't got it. Right. Okay. Well, you have to give us 30% of your ownership, and you'll get your 2% royalty. And at that point, like, you've given up all your rights to that silver. So it just seemed like a non-starter, unfortunately, which was a pity because I kind of had high hopes for it. But yeah, anyway, that's enough from me. Oakbloke signing off. Thanks for watching, and more articles coming soon, I'm sure. All right, cheerio for now. Cheerio.